Stop scrolling. Silver just sent a signal most people won't see until it's gone. The price hasn't exploded, mid-80s per ounce. Calm surface. But underneath, physical is being vacuumed through COMEX channels at a pace that doesn't match what the paper market shows. Registered inventories are thinning. Lease rates, the cost to borrow physical metal, are twitching upward after years of sleep. And the largest liquidity provider in this market, JPMorgan Chase, quietly flipped from short to long. Hundreds of millions of ounces. That's not a trade. That's infrastructure. If you're holding silver, watching it, or stacking it, this matters now. Because while the crowd waits for headlines, the structure underneath is already shifting. If you're here watching flows instead of price, you're ahead of 95% of the market. Your job isn't to predict the top, it's to understand what's moving first. I'm going to show you 2 patterns you can spot again and a watch list you can use tomorrow. Before we go further, hit subscribe. This channel watches what moves first, not what's already on CNBC. And if you're tracking flows, not just price, drop valve in the comments. I want to know who's in the circle that sees early. Here's what happened. For roughly 15 years, the public narrative stayed dismissive on silver. Industrial metal. Volatile. Dead money. Meanwhile, a single balance sheet absorbed physical through exchange-linked pathways, steadily, quietly. We're talking hundreds of millions of ounces, sitting in COMEX-eligible warehouses tied to JPMorgan. Not speculative positioning, strategic accumulation. Now, that same player flipped posture, short to long. At the same time, industrial demand is climbing. Solar installations, EV components, AI data center infrastructure. Silver is not just jewelry anymore. It's in the machines running the future. But here's the hidden layer most people miss. Price is the last thing to move. Stress shows up first in lease rates, then premiums on physical coins and bars, then warehouse reclassifications. Only after that does price react. Right now, those early signals are lighting up. This isn't about predicting a moonshot. It's about watching the structure that determines who gets squeezed when atoms matter more than contracts. Let me show you the first pattern. I call it the vacuum. Think of it like this. You've got a fire hose spraying water. That's the paper market. Futures contracts, ETFs, options. Infinite supply as long as people are willing to settle in cash. The spray looks powerful. It's visible. It's what everyone watches. But behind the hose is a tank. That's physical metal, atoms, coins, bars, warehouse inventory. And here's the problem. The tank is draining while the hose keeps spraying. As long as spectators watch the spray, nobody notices the tank dropping until it's empty. That's the vacuum pattern. Paper supply looks fine until physical drains faster than it can be replaced. Here's how it shows up now. COMEX warehouses separate silver into 2 categories, registered and eligible. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting there, stored, but not committed to clearing. Over the past year, we've seen registered silver drop while eligible silver gets reclassified or quietly withdrawn. The tank is draining. At the same time, physical premiums are rising. You can check this yourself. Go look at the spread between spot price and what dealers charge for American Silver Eagles or Canadian Maples. Normal premiums? Maybe 2 to 3 over spot. Lately? Pushing 4 to 6 depending on volume and timing. That's friction. That's the paper price not matching the cost to actually acquire atoms. Why does this pattern repeat? Because financial markets clear instantly. You can trade 1 million ounces of silver futures in seconds, just electrons moving between accounts. But atoms? Atoms don't teleport. You need refineries, transport, vaults, insurance, time. When paper supply is abundant and physical demand stays moderate, the system hums along fine. The hose and the tank stay balanced. But when physical gets vacuumed up, when one player or one category of demand shifts hard, the tank drains faster than it refills. And the paper market doesn't care. It keeps spraying until delivery day. Circle this. When atoms matter, paper lies. Not intentionally, structurally. The futures market is built to settle in cash. Most contracts never demand delivery, so price discovery leans on paper flow. Speculators, hedgers, algorithms, not physical scarcity. That works beautifully in both directions when physical is loose. It breaks when physical tightens, and someone actually wants the metal. We've seen this before. In 2011, silver ripped from $18 to $49 in months. Why? Because after years of paper suppression, physical buying overwhelmed the system. Mints couldn't keep up. Premiums exploded. Delivery delays stretched to weeks. The vacuum snapped shut. I'm not predicting that happens again. I'm showing you the mechanism so you recognize it when stress builds. Right now, the early signals are here. Thinning registered inventory, rising premiums, and lease rates starting to twitch. Your job isn't to front-run a squeeze, it's to watch the structure and know what you're holding when the valve tightens. Now let me add the second layer. I call this one the valve flip. Here's how it works. Dominant liquidity providers, banks, market makers, entities with massive balance sheets, often suppress volatility while they position. They lean short, they provide liquidity, they smooth out spikes. Why? Because calm markets let them accumulate without moving price. Imagine you're trying to buy 100 million ounces of physical silver. If you chase it in a rising market, you pay more with every purchase. You create your own squeeze. But if you can keep the market calm, provide liquidity, lean short on paper while securing physical through warehouse pathways, you acquire at stable prices. Then, once you've secured your position, you flip the valve. You stop suppressing, you go long, you let volatility return, and now you benefit from the very tightness you helped create. This isn't conspiracy. It's strategic positioning. It's what smart money does in any market where structure allows it. Silver has always been small enough for this to work. The entire above-ground silver market for investment is maybe 2 to 3 billion ounces. A few 100 million ounces moving through one balance sheet matters. And JPMorgan's positioning shift, documented through COMEX filings and warehouse data, looks exactly like a valve flip. Years of steady physical accumulation through COMEX-eligible channels, documented short positioning in futures during the accumulation phase, then a shift, short exposure unwound, long exposure established, physical secured, not predicting what happens next, showing you the pattern so you recognize the setup. Here's what's critical. The valve flip shows up in positioning changes, not press releases. You don't get a headline that says, dominant player completes accumulation. You watch warehouse data. You watch futures positioning through the Commitment of Traders report. You watch lease rates. Lease rates are especially telling. Think about it. If physical silver is abundant, lending it out is cheap. Nobody worries about getting it back. Rates stay near zero. But if physical is tight, if there's concern about availability, lease rates spike. Short-term tenors go first. 1 month, 3 months. Right now, lease rates are waking up after years of dormancy. Not explosive yet, but twitching. That's your early warning. When lease rates move before price, it means someone needs physical now and can't easily get it. That's atoms asserting themselves over paper. So connect the two patterns. The vacuum drains the tank. The valve flip determines who controls the pace when tightness arrives. Together, they create a scenario where price is the last thing that moves. But when it does, it moves hard. Because the structure underneath was already stressed. Your job isn't to time that perfectly. Nobody can. Could reverse tomorrow if industrial demand softens or a policy shift floods supply. But if you understand the mechanism, you're not confused when headlines lag what you're seeing in flows. Think about that. Most people wait for headlines. Silver surges on supply fears. But by then, premiums already widened, lease rates already spiked, registered inventory already thinned, the signal already fired. If you watch structure, you see it before the crowd does. Not advice. Pattern recognition. Here's what you need to sit with. The question isn't, will silver rise? The question is, who controls the valve when physical tightens and atoms matter more than contracts? Because right now, the structure suggests someone already positioned for that scenario. They secured physical. They flipped positioning. They're no longer the entity suppressing volatility. They're the entity benefiting from it. And if industrial demand keeps climbing, solar, EVs, data centers, and geopolitical risks add friction to supply chains, the vacuum accelerates. China controls a significant portion of global silver refining. If export restrictions or quotas appear, even whispers of them, physical availability tightens fast. We've seen this playbook in other commodities: rare earths, gallium, germanium, quiet policy shifts that ripple through markets not as price explosions, but as rationing, delays, and premium expansion. Silver could follow that path. Not a vertical spike, a grind, a slow tightening where price lags structure, and the people who get caught are the ones who wait for confirmation. By the time silver is on the front page, physical premiums are already elevated. Delivery delays stretch, mints ration allocations, dealers run low on inventory. You're not buying then, you're chasing, or you're holding and wondering when to sell. But if you don't understand the structure, you sell early, right before the real move. This is a quiet wealth transfer. Favors those who watch flows, who track inventories, who respect the signals that fire before headlines react. Not saying it's guaranteed. Could reverse if demand softens or a supply surge hits. But the structure is stressed now, and the biggest player already moved. What does that mean for you? It means your edge isn't prediction, it's observation. Let me give you 3 scenarios and then the exact signals I'm tracking. In the first scenario, physical premiums keep widening. Registered inventory keeps thinning. But price grinds sideways or drifts lower on paper selling. This frustrates holders. It shakes weak hands. It makes people question the thesis. But if you're watching structure, you see the stress building. Tightness is forming even as price lags. Winners here are patient watchers who accumulate physical on dips and don't get shaken by paper volatility. In the second scenario, positioning flips hard. Volatility returns. Price spikes as the market reprices for tightness. This could be fast. Days or weeks, not months. Lease rates spike first, then premiums explode, then price catches up. Losers here are late chasers who wait for confirmation and buy into elevated premiums and extended price. In the third scenario, China announces export restrictions on silver or silver-adjacent inputs. Headlines hit. Rationing language appears. Physical availability craters. Premiums detach completely from spot. Delivery delays stretch to months. No guarantees, just paths. Your job is to watch which signals fire and adjust accordingly. Now here's what I'm tracking this week and this month. Not telling you to trade these. Showing you what reveals stress. First thing I'm watching is COMEX registered versus eligible silver. Check this daily if you're serious. CME Group publishes warehouse data. Normal conditions mean inventory stays relatively flat and movements are gradual. Stress shows up as sudden reclassifications from registered to eligible, large withdrawals, registered inventory dropping week after week. Right now, registered has been trending lower, not collapsing, but thinning steadily. Second thing is silver lease rates, specifically the 1 to 3 month tenors. This is your early alarm. Under normal conditions, rates stay near zero or slightly negative because nobody worries about borrowing physical. Stress means short-term rates spike, with 1 month and 3 month tenors jumping before longer tenors move. You can find lease rate data through bullion banks or specialized commodity trackers. Kitco sometimes reports it. LBMA publishes some data. Right now, rates are waking up, not explosive, but moving. That's your signal. Third, I'm watching physical premiums versus spot. Check dealer websites like JPMorgan, SD Bullion, JM Bullion. Compare their prices on silver eagles or maples to the spot price. Normal means premiums stay tight, maybe 2-3 over spot. Stress means premiums widen and stay elevated, $5 or $6, even higher during real tightness. This tells you the paper price isn't matching physical acquisition cost. That's friction. Fourth is the COT report, the commitment of traders. CFTC publishes this weekly, and it shows positioning of commercials, banks, producers, versus speculators. Normal conditions show commercials net short because they hedge production and provide liquidity. Stress means commercials flip to net long or significantly reduce shorts. That's the valve flip showing up in data. Watch for positioning changes that don't match typical seasonal patterns. Fifth, I'm tracking China export headlines. Set a Google alert for China silver export or China rare metals quota. Normal means silence, no policy shifts. Stress means any language around quotas, restrictions, or prioritizing domestic use. This isn't predictive, it's reactive. But if it appears, physical markets tighten fast. Here's my risk thinking, not commands, just transparency about how I'm approaching this. I respect volatility. Silver can drop 20% in weeks and shake out everyone who over-leveraged or bought on emotion. I watch structure, not price. If registered inventory is thinning and lease rates are rising, I'm more interested in holding physical than chasing paper. I hedge with patience. If price drops, but premiums stay elevated, that's confirmation of tightness, not a breakdown of the thesis. I don't front-run squeezes. I position for scenarios where tightness persists, not for vertical moves. I track who's leaning. If commercials flip long and stay long, that's a structural shift I respect. Your approach might differ. If you're a trader, you might play volatility and accept whipsaws. If you're a long-term holder, you might accumulate on dips and accept paper drawdowns. No right answer, just different risk profiles. But if you're watching flows, if you're tracking lease rates and inventory and premiums, you're in the group that doesn't get blindsided when headlines finally catch up. Here's the bottom line. Price is the last thing to move. Structure whispers first. Lease rates, premiums, warehouse data, positioning shifts, those are your signals. And right now, those signals are firing. Not saying silver explodes tomorrow. Could grind sideways for months while physical tightens underneath. Could reverse if demand softens or policy shifts flood supply. But if you watch flows instead of headlines, if you track what moves first, you put yourself in the group that sees early. You're not chasing, you're not confused, you're not shaken by paper volatility when you understand the structure underneath. That's the edge. Not prediction, observation, not timing the top, understanding the mechanism. So here's what I want from you. First, what signal have you missed before? Maybe in silver, maybe in another market. Drop it in the comments. Let's learn from each other's blind spots. Second, are you watching lease rates or premiums first? Binary question. Tell me which one you think moves hardest when stress hits. If you got value from this, if you're thinking differently about how to watch silver, hit subscribe. This channel tracks structure, not hype. We watch what moves first. And if you want the links to check COMEX inventory, COT reports, and dealer premiums yourself, I've dropped them in the description. Your job is to verify, not take my word for it. Final thought. The people who make money in tight markets aren't the ones who predict the top. They're the ones who positioned early, watched structure, and didn't get shaken when paper volatility tried to scare them out. Price shouts last, structure whispers first. If you're listening to the whisper, you're already ahead. See you in the next one.